Welcome to StockTok's deep dive into Boeing Co. Boeing is the world's largest aerospace and defense contractor, designing and manufacturing commercial aircraft, defense systems, and space exploration hardware for governments and airlines across the globe. The company is a cornerstone of global aviation and plays a critical role in national security infrastructure. As of May 11th, the stock is trading at $238.79, positioned near the middle of its 52-week range between $176.77 and $254.35. The stock has moved up 7.03% from recent lows. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Boeing operates three primary segments: commercial airplanes, which generate the majority of revenue from aircraft sales to global carriers; defense, space, and security, which serves the U.S. Department of Defense and international governments; and Boeing Capital, a financing division. The company's competitive moat rests on switching costs. Airlines cannot easily replace aircraft, certification barriers protect Boeing from new entrants, and supply chain relationships create stickiness. However, that moat has faced pressure in recent years. Boeing's StockTok score is 37 out of 100, signaling caution across all 5 dimensions. Valuation rates 13 out of 20, financial health 8 out of 20, profitability 1 out of 20, growth 7 out of 20, and smart money positioning 8 out of 20. Now, valuation. The question every investor has to answer is, are you paying the right price? Boeing's price-to-earnings ratio, or PE, stands at 109.2 times trailing 12-month earnings. That is extremely elevated, driven by severely depressed earnings. The forward PE, or price divided by next year's projected earnings, is 8,140.04 times. A figure so distorted it tells us the market is pricing in continued losses ahead. The PEG ratio, which adjusts the PE for growth expectations, registers at 0.00, reflecting near-zero growth assumptions. The enterprise value to EBITDA multiple, or EV to EBITDA, sits at 28.12 times, roughly double what the aerospace sector has historically traded around. Our DCF analysis, a discounted cash flow model projecting future cash flows, suggests the stock is trading at 0% premium to intrinsic value, indicating the market has already priced in significant headwinds. Wall Street analysts have issued a consensus mean price target of $270 per share, implying approximately 13% upside from current levels. The analyst consensus recommendation is buy, though the range spans from a low target of $230 to a high of $300 across 25 analysts. Taking both signals together, a reasonable fair value range in our view sits between $230 and $300. Market sentiment around Boeing leans neutral. Upcoming earnings on July 28, 2026 will be a near-term catalyst to monitor, with consensus expecting a loss of 0.24 per share. Moving to financial strength, how solid is the foundation? Boeing's Piotroski F-score, a 9-point checklist that grades financial health, comes in at 7 out of 9. That is moderately healthy, indicating some underlying financial discipline despite near-term stress. However, the Altman Z score, a bankruptcy risk model combining 5 financial ratios, registers at 1.62. Scores below 1.81 indicate distress, meaning Boeing's financial structure is flashing warning signs. Examining the balance sheet more closely, the cash-to-debt ratio stands at 0.44, indicating Boeing holds only 44 cents of cash for every dollar of debt. That is lean, leaving minimal cushion. Interest coverage, which measures the company's ability to service debt from operating earnings, registers at 0.00 times, meaning the company is not generating positive operating income to cover interest payments. This is a critical red flag. The current ratio, a liquidity measure of current assets divided by current liabilities, sits at 1.18, just barely above the 1.00 threshold required to cover short-term obligations. The debt-to-equity ratio is 7.89, meaning the company carries nearly $8 of debt for every dollar of shareholder equity. That leverage is extreme for a company with distressed profitability. The verdict is clear. The balance sheet is under stress, with insufficient liquidity buffers and dangerously high leverage relative to earnings power. Next up, profitability. Is this business actually making money efficiently? The answer is no, not right now. Boeing's return on invested capital, or ROIC, is negative 4.55%, meaning the company is destroying shareholder value. For every dollar of capital deployed, the company is losing value. The gross margin, the percentage of revenue left after subtracting the cost of goods sold, is 4.79%. For a company of Boeing's scale and market position, that is exceptionally thin. Most aerospace primes command gross margins in the double digits. The operating margin, which represents profit after all operating expenses, is negative 5.89%. The company is operating at a loss before accounting for financing costs and taxes. The net margin, or net profit divided by revenue, is 2.46%, modestly positive only because of one-time gains or tax benefits, not from core operations. Free cash flow margin, the percentage of revenue converted to actual cash available after capital expenditures, is negative 1.14%. Not only is Boeing not profitable on an earnings basis, it is burning cash. These metrics paint a picture of a company struggling with operational execution, with bloated cost structures, and with manufacturing inefficiencies. Until gross margins expand and the company returns to positive operating income, shareholders are not being rewarded for capital deployed. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 10.3%, representing a cumulative increase as the company recovered from pandemic disruptions. However, over the past 5 years, revenue growth slows to 2.1% annually, indicating the company's long-term trajectory is much more modest. The most recent quarterly results, reported approximately 54 weeks ago, showed revenue of $22.22 billion, actually declining 7.2% year-over-year, signaling recent deceleration. Book value growth, which measures the expansion of shareholder equity, has grown 0.00% over the trailing 3 years, meaning the company has not expanded its net worth despite nominal revenue gains. The company carries no dividend yield, as Boeing suspended its dividend to preserve cash during this distress period. The picture here is one of a mature, cyclical business in a recovery phase after pandemic disruption, but lacking secular growth tailwinds. Management has not provided forward guidance signaling accelerating growth, and the upcoming earnings estimate of a loss of 0.24 per share suggests the company expects continued near-term pressure. Growth is not a compelling argument for Boeing at this stage. Now let's talk smart money. What institutional capital is actually doing with this name? 20 top-tier gurus currently hold Boeing stock, including prominent investors such as Hillman Capital Management, Harry Byrne at Sound Shore, Viking Global Investors, Sarah Ketterer at Causeway Capital Management, and Mayors and Power Funds. However, their conviction is mixed. Hillman Capital, which holds Boeing at 3.47% of portfolio weight, has reduced its position by 10.76%, signaling reduced conviction. Viking Global, holding 2.29% of portfolio, has added 31.31% to its stake, suggesting increased optimism. Harry Byrne at Sound Shore, holding 2.37%, has chosen to buy. Sarah Ketterer has also initiated or increased her buying. Overall, institutional ownership data shows that 15.4% of 13F filing institutions are net buyers, below the 50% threshold that would indicate net bullish sentiment from the institutional community. This means more institutions are reducing or holding steady than are adding to positions. Insider ownership is remarkably low at 0.6%, indicating management has very little skin in the game. a misalignment that often raises questions about management conviction. Insider transactions over the past 3 months show 1 buy and 3 sells, favoring the bears and suggesting insiders may be reallocating wealth away from company stock. The verdict on smart money is cautious. Some prominent value investors are accumulating selectively, but the broader institutional base is not rushing in, and management is not demonstrating conviction through personal buying. And finally, the verdict. Let's bring it all together. On valuation, the stock is trading within a fair value range we estimate between $230 and $300 per share, roughly aligned with analyst consensus but supported by a market already pricing in distress. On financial strength, Boeing's balance sheet is under stress, with high leverage, thin liquidity, and negative interest coverage signaling the company must stabilize operations or face capital structure risk. On profitability, the company is currently destroying shareholder value, burning cash, and operating at an operating loss. This is the core problem that must be solved before any investment thesis gains credibility. On growth, Boeing is a mature cyclical business recovering from pandemic disruption, growing at low single-digit rates with no dividend and no clear secular tailwinds. On smart money, institutional capital is cautiously positioned, with some value investors accumulating but the broader base unmoved, and management displaying minimal conviction through insider ownership and recent selling. In our view, a fair value range for Boeing sits between $230 and $300, representing approximately 0 to 13% upside from current levels depending on execution. The company's recent earnings results showing continued operating losses reinforce the core challenge. Boeing must demonstrate a clear path to margin recovery and positive operating income before this setup becomes attractive on a risk-adjusted basis. This is a turnaround story, not a growth or quality narrative. The upside scenario assumes management executes a cost, restructuring and returns the company to mid-teen operating margins within 2 to 3 years. The downside scenario involves delayed recovery, further operational challenges, or balance sheet stress forcing capital raises that dilute shareholders. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Boeing Co. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.